Ladies and gentlemen, thank you for standing by and welcome to the Ramsay Healthcare FY21 Interim Result Conference Call. At this time, all participants are in a listen-only mode. After the speaker's presentation, there will be a question and answer session. To ask a question, you may press star 1 on your telephone. I will now hand the call over to our presenters for today. Please go ahead, presenters.
Thank you. Good morning, everyone, and welcome to the Ramsay Healthcare FY21 Interim Result presentation. My name's Craig McNally and I'm the Managing Director and CEO of Ramsay Healthcare, and I'm joined by Martin Roberts, Group Chief Financial Officer. Today we'll provide an overview of our group performance for the 6-month period, a breakdown of our performance by region, an update on group financials, including cash flow and liquidity, and an overview of our strategy before covering off on the outlook for the group. While the first half result was impacted by further outbreaks of COVID across all our regions, I also believe it demonstrates our operational and financial resilience, and in particular the commitment of our frontline staff and doctors who have borne the brunt of the pandemic. Our strong balance sheet and cash flow have allowed us to continue to invest in the business during the first half of the year, despite the disruption to our day-to-day activities. We opened 2 new facilities in the UK, acquired 2 facilities and disposed of 2 facilities in France, and exited the German market, selling 9 hospitals. We also made significant investment in brownfield developments in the expansion of our existing portfolio. Our long-term strategic focus will continue to be on leveraging our existing business platform to create a broader integrated healthcare services provider. We think Ramsay is well placed to achieve this goal through both new investment and organic growth. Looking to the more immediate outlook, while we're always cautious about making predictions in the current environment, there's a sense across the business that the operational and financial outlook is slowly improving. While the profits of the recovery in each region will be different and likely bumpy, I believe Ramsay is well placed to take advantage of the demand from surgical backlogs and latent demand for non-surgical services. Before we go through the result in detail, I'd like to highlight our ongoing response to the pandemic, and in particular, the people leading our response. Our extensive facilities, dedicated employees and doctors, and clinical expertise and experience have been utilised to assist with the public sector response to the further outbreaks of the virus. Ramsay's overwhelming primary focus during the pandemic has been to protect the safety and well-being of our patients, staff and doctors. Fatigue and mental health have become significant issues faced by our employees and clinicians, in particular in our Northern Hemisphere facilities. And retention and recruitment of frontline staff is a challenge across the sector. In Australia, we moved to surgical restrictions in Victoria in July, and our teams moved quickly to assist with providing care in both the public hospital and aged care systems. The restrictions started to unwind from late September, with full operational capacity returned in late November. In the UK, we signed a revised agreement with the NHS England in October, covering the period from 1 July through 31 December 2020, that allowed for Ramsay UK to receive net cost recovery for its services to NHS England, and allowed for the return of some capacity for private patient activity and routine NHS elective surgery activity. During the pandemic, Ramsay UK has looked after over 500,000 NHS patients, treating the highest volume of NHS patients in the independent sector. With over 20 NHS services hosted in Ramsay facilities and 210 Ramsay team members supporting NHS teams in local trusts. In Europe, the business has continued to operate under government arrangements that provide for payments for the use of Ramsay facilities and capabilities to assist with the outbreaks of the pandemic. Since October, our teams in France and across our business in the Nordics have been assisting governments with the impact of the second wave of the pandemic as well as urgent non-COVID health issues. At the peak of the second wave, 45 of Ramsay's hospitals and clinics in France were treating over 900 COVID patients, with more than 300 patients in critical care. July through December, Ramsay Santé in France alone treated more than 5,000 COVID patients, including more than 2,000 in critical care. Our UK, European and Asian facilities continue to assist the public sector with the health response to further COVID outbreaks. Improvements and updates were made to policies and procedures after the first stage of the pandemic. It means we've been better prepared operationally in these subsequent outbreaks, including in managing additional costs, and we're well equipped to handle future challenges that may arise with this or other viruses. I'd like to thank all our staff across the regions for stepping into the breach again and ensuring that Ramsay has led the private sector, treating more patients than other providers. The board and senior management team understand the toll this has taken on our employees' lives, and we thank you for your commitment. Moving to our results. Today, Ramsay reported a statutory net profit of $226 million, down 12.5% on the prior period. The result reflects the restrictions on our patient capacity caused by further COVID outbreaks across our regions and the additional costs associated with operating in a COVID environment. In addition, we experienced a negative impact from case mix as the demand for non-surgical services declined, reflecting a reluctance to visit hospital settings and social distancing restrictions associated with operating in a COVID-safe way. The result includes government-funded payments for the use of Ramsay's services and facilities during recent outbreaks. This has included both revenue support and cost recovery payments that are recognised in total revenue. The board was pleased that the company is in the position to resume the payment of dividends, declaring a fully franked interim dividend of 48.5 cents per share, representing a payout ratio of 50% of statutory net profit. While the dividend is below the prior period, it reflects the strong cash flow generation and solid balance sheet position of the company, despite the ongoing impact the pandemic has had on our earning capacity. Based on feedback we'd received from the market, we decided from FY21 not to report a core non-core earnings split. To ensure a like-for-like comparison is available, we have revised the regional core earnings split in the prior period to include non-core items. There are a number of what we would previously have classified as non-core items in this result, which we will highlight for you as we go through the pack. The largest item was a net gain on disposal of assets and investments of $44 million compared to the prior period. This item reflects gains on the disposal of 2 facilities in France, medical suites in Australia, and the reversal of a provision taken against the hospitals in Germany at the time of the Capio acquisition. So moving to the regional results. The Australian result reflects the restrictions on capacity in Victoria for the majority of the 6-month period, combined with increased costs associated with the COVID operating environment. The impact of case mix changes flowing from the decline in demand for non-surgical services and the transfer of the operation of Mildura Hospital back to the Victorian State Government in September. Revenue from patients was up 0.5%. However, excluding Victoria, revenue was up 4.9%, reflecting strong surgical volumes, partially offset by lower demand for non-surgical services. Excluding Victoria, demand for some non-surgical services started to pick up in the second quarter. However, medical, mental health, maternity and rehabilitation services remain subdued. We believe demand has been impacted by physical distancing and inpatient visitor restrictions, combined with a reticence in some parts of the community to enter the healthcare system during the pandemic. The result includes a $10.5 million benefit from the sale of assets compared to the prior period. The costs associated with operating in a COVID-safe environment, on average for the 6-month period, were $8.2 million per month, excluding Victoria. Turning to the outlook, as you can see in this chart, trends in Ramsay's admissions per workday versus the prior period in both surgical and non-surgical services, both including and excluding Victoria, have been stronger through December and January. In particular, demand for non-surgical services has picked up, although demand for day patient rehab and psych services has continued to lag. Based on forward bookings, we are seeing stronger demand for maternity services in the period February through April. We expect surgical growth to remain strong, but the rate of growth is expected to slow with reduced inpatient growth against the day patient growth. We have had some disruption to the admission pipeline recently due to localised COVID outbreaks, resulting in snap lockdowns in Western Australia, Queensland and Victoria. Moving to our investment in the business, total capital expenditure for the Australian business was $121 million over the 6-month period. This was below the prior period, given the number of projects that completed ahead of schedule at the end of FY20. Key projects completed during the 6-month period included the Day Oncology Unit at St George and the redevelopment of Nowra and Dudley hospitals. Total capital expenditure for the full year is expected to be in the range of $250 to $300 million. So moving on to the European business, the result reflects an incredibly busy period for Ramsay Santé, as they managed to handle the demand for both urgent and elective surgery, combined with assisting governments across its jurisdictions with further outbreaks of the pandemic. The absence of the normal first half seasonality due to the smoothing impact of the calculation of the revenue guarantee boosted earnings. The result includes a $33.8 million positive contribution from the disposal of assets in France and Germany compared to the prior period, reflecting the ongoing restructure of the European portfolio of facilities. The stronger Nordic region result reflects the different structure of the payment system in some parts of the region, combined with the generally lower impact of the pandemic. Turning to the outlook for the business, and there remains a high degree of certainty around the operating environment in the short term, given COVID cases continue to surge and the vaccine rollout, while commenced in France, is taking longer than other countries to pick up momentum. The French government has committed to issuing a new decree providing revenue and cost support from the 1st of January 2021 for a period to be determined. However, it is likely we'll see that, and the indications are we'll see that run through till June. The business will continue to assist governments in addressing the backlog of cases and the rollout of the vaccine in France, with a number of vaccination centres created within our hospital facilities. So moving to the UK. While activity levels were slow to pick up, private patient and NHS routine elective surgery volumes returned in September. Private patient volume was particularly strong, and the result benefited from a favourable mix of private patient volume over the period. Ramsay UK continued to support the NHS as further outbreaks of the virus started to overwhelm the public system. Turning to the outlook, Ramsay UK is operating under a new volume-based agreement with the NHS England, and that's from 1 January to 31 March 2021. The NHS may trigger a peak surge period on 7 days' notice, should Ramsay's capacity be required to enable the NHS to respond to COVID cases. Importantly, Ramsay is able to continue providing private patient services under the new agreement. In the short term, Ramsay UK will be impacted by the headwinds associated with the uncertain COVID environment, and potentially may be impacted by Brexit and the flow-on of impact to supplies of materials. In the medium term, the business expects to benefit from volume associated with the NHS waiting list and growth in private demand. Finally, moving to Asia and our joint venture Ramsay Sime Darby. There were no restrictions on elective surgery in Malaysia or Indonesia over the 6-month period. However, movement controls impacted patient volumes. In November, there was a government directive in Hong Kong postponing all elective surgery. The joint venture has benefited from running PCR testing, and our facilities in both Malaysia and Indonesia have been treating patients flowing from overwhelmed public systems. Our hospitals in Indonesia have been treating government, insured and self-funded COVID patients. In terms of the outlook for the region, a return to normalcy in elective surgery and medical admissions will be dictated by the ability of countries in the region to reduce the spread and impact of COVID. A vaccine program has started in Indonesia, and the joint venture has been appointed to assist in rolling out the program. Vaccinations have commenced in Malaysia in recent days. We will continue to assist with PCR testing and supporting the public system with overflow. I'll now hand to Martin to go through some of the financials in more detail.
Thanks, Craig, and good morning, everyone. As Craig has highlighted, the operating environment, including the government agreements we operated under during the period, has made interpreting our results for the half extremely challenging. The results from our Northern Hemisphere region will continue to be impacted by some of these forces into the second half of the fiscal year, with France expected to operate under a new government decree and the UK back to operating under a volume-based agreement for the third quarter. However, the NHS can and has called upon capacity when required. In Australia, while operating with no capacity restrictions at the current time, the business disruption caused by the snap lockdowns that we have experienced in the last few months has had an impact on operating results as the pipeline of admissions is disrupted and costs associated with operating in a COVID environment spike again. It is worth noting that our effective tax rate for the period was lower than in the prior period at approximately 33% due to adjustments in Ramsay Santé in the prior period. At the current time, we expect the effective rate for the full year to be broadly in line with the half year. Moving to cash flow. You can see the working capital boost to cash flow over the period, reflecting that advances received under revenue guarantee arrangements in France were in excess of revenue guarantee accruals. The positive impact on working capital is expected to reverse in the second half, following the harmonisation of payments received over the 9-month period from March to December with actual revenue. This true-up is expected to be completed in the next few weeks. In addition, it is looking like the new revenue guarantee scheme that Craig referred to earlier may well be a payment in arrears set up as opposed to payment in advance, so that will also have a negative impact on the cash flow in the second half. Outside of that, free cash flow was strong, reflecting lower finance and tax charges and lower capital expenditure. The result of the pull forward of expenditure into last year as projects in Australia were completed ahead of schedule. Moving to the balance sheet, which remains in a strong position. The two significant movements were a material reduction in net debt flowing from the capital raising in April and May last year and the movement in working capital. In response to feedback on Ramsay's FY19 remuneration report, the board has introduced a number of changes to its executive remuneration structure from FY21 to better align it with outcomes on return on capital employed. At the AGM in November, we committed to provide the threshold and stretch performance levels for our FY21 LTI grant at this result. This detail is in the operating and financial review we released this morning. However, in summary, for the EPS part of our LTI, we have included a gateway which would trigger if ROIC is above WACC. The 3-year EPS CAGR target range for the EPS part of our LTI will be between 3 and 9%. As you can see on this next slide, we have significant financial flexibility to fund development and expansion opportunities that may arise, with $2.3 billion of liquidity available in our wholly owned funding group. We are currently working on refinancing the bank debt, which is due in October 2022. And with that, I'll now hand back to Craig to touch on our strategy and outlook.
Thanks, Martin. Turning to the group's strategic direction. We continue to evolve our business platform consistent with becoming a broader integrated healthcare services provider. We will look to deliver shareholder value through both organic growth and the development of new growth platforms for acquisitions and expansion into new areas. Efficiency programs and building the sustainability of our platform will continue to be key measures to improving shareholder returns. We continue to develop our global sustainability strategy and integrate it into our business practices. As part of this push, the board has recently committed to align our reporting with the recommendations of the Task Force on Climate-Related Disclosures, and that'll be in our FY21 corporate reporting. So turning to the outlook for the group, Ramsay's result for the second half of FY21 will be dictated by the shape of the pandemic curve in each of our regions, and thus the extent to which we can operate on an unrestricted capacity basis. While early data from offshore markets suggests vaccine rollouts are reducing the number of severity of cases, significant uncertainties remain with the rates of vaccination and the medium-term clinical outcomes of the various vaccines. The costs associated with operating in a COVID environment are expected to continue for the foreseeable future, but are gradually reducing through better management and where there is a lower prevalence of the virus. Ramsay will continue to invest in the business and optimise our facilities and footprint to strengthen our competitive advantage and leverage our scale. Our strong balance sheet and cash flow provides us with the flexibility to pursue our long-term strategy to create a leading ecosystem for patient-centric integrated care. In the short to medium term, surgical backlogs and latent demand for non-surgical services are expected to drive volumes as the general public's comfort with the hospital environment improves. We expect to assist with relieving pressure on public waiting lists across our regions. While we have every confidence in the outlook for the business, given the ongoing uncertainties in the environment we are operating in, we are unable to provide guidance for FY21 full-year results. Martin and I are now happy to take questions.
Operator, we'll hand over to you for questions.
Thank you, ladies and gentlemen. We will now begin the question and answer session. To ask a question, you may press star 1 on your telephone and wait for your name to be announced. To cancel your request, you may simply press the pound or the hash key. And please note there will be a short pause as questions are being collated. We thank you for your patience. The first question is from Chris Cooper from Goldman Sachs. Your line is now open, Chris.
Hi, morning. Thank you. Just looking at slide 8, I mean, it's good to see the momentum continuing into the second half. But it does seem that Victoria is still dilutive in December and Jan, despite being unrestricted through that period. Can you just talk to that dynamic at all, please?
I mean, when you come out of the lockdowns, you're not necessarily immediately straight back into it, particularly on the non-surgical services. But I've got confidence that Victoria will continue to return to normal activity as the other states have done. So I don't think there's anything unusual about that.
I mean, is it possible it's a function of timing of Christmas and New Year? I mean, I'm just looking at that chart and seeing a very strong catch-up in that first month in the other states, and it didn't seem to play out in Victoria in quite the same way. I'm just wondering whether there's any sort of reason why there's perhaps a bit more of attrition down there.
Yeah, well, there'll be I think that's absolutely true, Chris. And so we had lots of people take the opportunity to take leave, particularly doctors, over the January period. And it also excludes Mildura. So Mildura has come out of our numbers since September.
Understood. Thank you. Just on PPE and COVID costs, you've talked to the fact that these are now, going to continue, but you expect them to come down. Can I ask how much of that expectation is driven by price per unit and how much of that is volume of these PPE costs? And I know it's impossible to predict, but can I just ask how you're thinking about it at this stage, I guess? I mean, would you expect to enter first half 22 at better or worse than half the run rate that we saw in the first half of 21?
Yeah, Chris, it's Martin. So obviously, there was only a small part of that 8.2 million a month was PPE. But the way we're looking at PPE is we purchased a huge amount of PPE during the middle of the crisis, which was probably, unfortunately, at peak prices as well. So while some of the prices have come down, actually some of the PPE items prices still continue to rise, but I'd say on average they've come down. But we won't see the benefit of that for quite some time because we had, between 6 months and 2 years stock on hand of certain items. So it's going to take quite a while for that to flow through. With regard to usage, that will come down a little bit, but certainly not anything material.
Okay, and just sort of illustratively, I mean, would you expect to exit this year at sort of half the run rate that you had at the start of the first half period? Would that be a reasonable assumption at this stage, or are we a little
not with regards to PPE, no. So if you think of that 8.2 million, a fair amount of that, or let's say a quarter of it, was roughly the procurement benefits that we missed out on during calendar 20. So we would expect that to start to reverse in calendar 21, depending on volumes that we get during this calendar year. I mean, if Australia keeps trading the way it is, then that should be okay. PPE cost, as I said, will take a while to come down. The other element of that was the cost of screening at the entrance of our hospitals, where, as restrictions came off in parts of Australia, we could actually automate that using apps, etc. But then when we enter snap lockdowns, we have to put screeners back on the front of the hospital. So that will be spiky over time, but that should come down over time as well.
Got it. And just lastly, just very quickly, any update on the potential waitlist tender out of the UK with the NHS, please? Thank you.
No real update, to be honest. The second wave has sort of thrown things into the melting pot a little bit. There's absolutely still a commitment for it. The impact of the numbers are COVID numbers are starting to look better in the UK, but there's jury's still out on what the impact of the vaccinations be and the length of time that will take to get back to a sort of normal period. So look, you would hope that the volumes would start to flow sooner rather than later, but it's really difficult to predict at this point.
Thanks very much.
Okay, thank you. Our next question comes from the line of Leanne Harrison from Bank of America. Your line is now open, Leanne.
Hi, good morning, Craig. Good morning, Martin. Thank you for taking my questions. Similar to Chris, I found slide 8 quite useful. If you had a slide similar to that for Europe, could you give us some indication what we would see trend-wise on a month-on-month basis?
I won't go into that much detail on it. Yeah.
Oh, anything similar.
But for France, which has a similar sort of portfolio of assets and case mix, it's not vastly different. I mean, the return of France didn't build up the same backlog necessarily, but you won't get a dissimilar profile. You'll have surgical services up, you'll have the non-surgical services down, and that's sort of medicine and mental health. Obstetrics continues to be down across the private sector anyway, irrespective of COVID. So look, without going into the absolute profile on a month-by-month basis, it's not going to be vastly dissimilar for France, albeit the additional lockdowns we'll see, environment they're in at the moment, we'll see that dampen. So we'll probably see that sort of slower to recover over the next period than we would see Australia.
Okay. Right. And in terms of the quantum, so with the Australian scale, it's from I guess up to for January might be up about between 5 and 10%. Would France be similar to that, or would it be different?
Not at the moment.
Slightly lower. Okay.
Yeah, not at the moment. I mean, France, we sort of, and I don't want to certainly underplay the situation in Europe because it is difficult. I think we find it difficult from Australia to put it in perspective, but they're in a position that they were back in the start of last year in terms of the impact of the virus on what's happening around not just healthcare in France, but generally around the community. So it's not going to be the same as Australia.
Okay, thank you. And if we could turn then to Australia, obviously given the COVID caseload has been lighter, and we're fortunate for that. But to what extent do you think that the surgical backlog in Australia has been worked through? And any colour you can provide on, types of admissions would be helpful.
Yeah, look, I think we've still got some way to go on that. I've always said that I thought it would be longer and lower in terms of the backlog. And still, what we can't get the data points on is the rate of entry into the system. So what is the makeup of the premium volumes that we're servicing at the moment? How much of that is backlog as opposed to how much is really coming in at the front end? So I think it is slower and longer.
Okay. And are you seeing any public volumes come through yet in Australia?
Yeah, and it's a state by state or even a local area by local area issue. But we've got a couple of states where we've seen increased volumes of public patient surgical services primarily, and some states where we haven't seen that come through yet.
Okay, thank you very much.
You're welcome.
Thank you. Our next question comes from the line of David Lowe from JP Morgan. Your line is now open, David.
Thanks very much. My question's really around the Australian margin, so down 460 odd basis points. Just wondering sort of what the key contributors to that weakness are. I mean, I think the obvious buckets are Victoria, COVID costs and mix. Any help you could give us on how to attribute that, because particularly as Victoria comes out, just trying to get some sense as to where margins might go.
Yeah, David, it's Martin here. So it's hard to really think of the Australian business or any of our businesses currently from a margin percentage perspective because of the impact of the various different government arrangements that we've got. So you quite rightly pointed out that we've called out that the impact of the Victorian restrictions in the half was $70 million. Add to that the $8.2 million, a month in additional COVID costs, so $49 million. That's pretty much most of the variance between this half and last half, with a couple ups and downs with the profit on the sale of the medical suites and a couple of other provisions, etc. The actual balance then in terms of mix, etc., as Craig was talking about before, and we put in the materials, positive increase in surgical offset by a negative increase in non-surgical, where with surgical being bigger, but non-surgical being much higher margin. So the two of those kind of net each other out, so you really have a very minimal kind of underlying ex-Victoria trading mix benefit from what we've done. So if that's helpful.
Yes, it is. Thank you. You've touched on mix there. So the non-surgical parts, so mental health, rehab, and medical patients all got mentioned in the commentary. Any sort of sense as to what the trends are in those segments and whether we should be expecting improvement over the next 6 months or so?
Yep. I mean, January, you see the January numbers in slide 8, I think.
Yeah.
In slide 8. Too short a period to draw a trend off, David. But we're expecting an improvement in all of those therapeutic areas. I mean, this week our mental health facilities, both inpatient capacity and day patient programs, have been full for the first time since COVID. Too short a period for this week to draw the longer term trend off that, but that's encouraging. And we'll see. Well, in medicine, a big piece of it is respiratory, so that will depend on what happens with flu season again. And but we expect as the environment opens up and people are engaging again, that you expect respiratory conditions to increase and thus medical volumes to increase. There's a number of other things in medical as well, obviously. So I guess
importantly,
the question is, we expect it to improve.
Nothing holding back mental health, it would seem, and rehab presumably is linked reasonably closely to levels of surgery. So both of those, it seems like the early signs are quite positive.
Yeah, look, I think in all of those, one of the key things that we probably underestimated, in the first half of last year, but became evident to us as the year went on, was the impact of visitors, and particularly for those longer length of stay procedures, not so much for surgery, but for rehab, mental health. People were concerned about not having visitor contact over an extended period of time. So that's an issue that is sort of improving, as time goes on.
All right, look, the last one for me. The UK, quite a strong result. I mean, can that continue at that level? I mean, I know COVID's very hard to predict, and I know that the start of the period's not great, but the contribution there looks pretty impressive given those circumstances. Do you think it's reasonable to assume it can be matched again in this half, or should we think differently?
Yeah, I wouldn't be trying to extrapolate any results from the first half into the second half. It's one of the many reasons why we've not been able to give guidance. What I would say is we've tried to help in the OFR by splitting out the new interest costs from AASB 16 from our financing costs. So because in the UK, we're basically getting all our costs covered, including rent. And as you know now, rent, large part of it's sitting in the interest line. So we try to help users there. And if you look at that, the EBIT less financing costs associated with leases was 7.9 million Aussie dollars in the period. So it's not a huge number. That number is essentially from the increase we had in private patient activity during the half. And we actually made a loss in the prior period. So yes, it's quite a large percentage increase, but in terms of dollars, it's not a huge amount. And it's hard to say what it's going to look like in the second half because we're under a completely different arrangement now, and we're volume based, and it depends what the volumes come through and what the mix of that looks like. So pretty hard to predict.
All right. Thanks for trying. Thank you.
And our next question comes from Wasil Jani from Credit Suisse. Your line is now open, Wasil.
Thank you. It's Gretel here. So just firstly, in Australia, the surgical volumes that have returned, how have you seen the surgical case mix relative to pre-COVID levels? Is it relatively the same, or has there been a high level of acuity? Just some comments on that would be great. Thanks.
Yeah, look, it's an interesting one. A lot of the sort of catch-up work for the backlog is lower acuity because the higher acuity work was done. The higher acuity work generally wasn't deferred. So in terms of surgical case mix, we're seeing a bigger proportion of lower acuity work in the total at the moment.
Okay. And then just moving on to labour, so you talked about some of the difficulties in the Northern Hemisphere at the moment with labour. So are you anticipating a shortage? Are you giving greater incentives to the staff? And I guess, is this going to be one of the biggest headwinds, post-COVID as you look forward to a recovery in the Northern Hemisphere businesses?
It's a significant issue for us. In France, you will have seen that the staff got a significant nursing staff got a significant pay increase right across the system, public and private. But they're just fatigued. There's a lot of energy going into treating COVID patients. The absenteeism has increased, which is no surprise because there's plenty of staff and their families and friends who are COVID positive. So look, it's all I'll say is it's challenging, and it's top of mind for us in how we support the staff and make sure that we provide the safest environment we can as a priority, but then to make sure that we can take as much pressure off them as possible, and we'll continue to do that. And hopefully we put ourselves in a position where we are seen as a good employer, and that holds us in good stead into the future.
So I guess it's probably a little bit too soon to see if there's going to be an impact to the recovery, I guess, from this angle. Is that right?
I think so, yep. I think that's right.
Thanks, that's all I had.
You're welcome.
Our next question comes from Andrew Kuso from Anstey Naki. Your line is now open, Andrew.
Oh, good morning, and thanks very much for taking my questions. I know you've talked to the duration of the recovery, and I guess in terms of years, is one of the factors in terms of how much you can capture each year, just your own capacity or medical capacity? What sort of cap would you see that sort of putting on sort of the opportunity to participate in this growth recovery?
Yeah, in theory that's right, but we certainly haven't been restricted to date, and I don't think we're going to be honest. There's three types of constraints on capacity. I think I've spoken about this before. You've got the physical constraint about how much physical capacity you have in terms of operating theatres, beds, etc. You've got your staffing capacity, and you've got doctors and their appetite. And I think the trends we're seeing, I think we can manage whatever that premium is going to be for quite some time. So I don't see that our own constraints are going to limit us. Generally across markets, I think in the UK we're probably more constrained from a physical capacity point of view. So we've got some facilities where they're pretty full anyway. So we've got to look at ways that we can create that capacity. But there's smaller units in the UK and generally easier to create capacity in a short time frame.
And if we just to take the sort of that slide 8 that gives us sort of a picture of where you were in January, I mean, is that being done with relative ease and reasonably sort of sustainable at those sort of levels?
Oh, sure. Yeah. No great pressure on that.
Yep, got it.
The staff probably not much.
And then just in terms of that recovery that you've seen in January, if you were to look at items that you might regard as lead indicators, things like colonoscopies and other diagnostics and so on that you might be performing, how would you sort of see those sort of relative to that chart, or where would they plot and give you?
Yeah, they're certainly increasing, and that referring to the lower acuity surgical services. You've got the endoscopy work that's certainly included in that, and we're seeing significant increases in that.
And would those increases be at the sort of, where would they be relative to the green line? Would they be the surgical? Would they be sort of above or sort of similar?
I won't answer that, Andrew, because I don't have it in the top of my head. No, sorry.
No worries. And I guess just just sort of thinking about the duration of the backlog, I know you've sort of responded to this a bit, but I mean, if we sort of think that's in most jurisdictions, sort of what we've seen in this country, Australia, would Australia be sort of on the more positive edge of the sort of backlog relative to the UK? I mean, we do get opportunity to see the UK. There's a lot of unmet demand, I suspect, too, that we just can't quantify. But just, well, how are you sort of seeing it on a scale of sort of which countries have the deeper backlog?
UK certainly. The UK had a starting position that was worse than anybody in the before COVID. So, and as we've talked about previously, the government has made the commitment to put the additional funding in to address the sizable backlog in the UK, but that's certainly the market that's in the worst position.
Okay, great. Thank you very much.
Welcome.
Thank you. Our next question is from Saul Hadassin from UBS. Your line is now open, Saul.
Thanks. Good morning, Craig and Martin. Can I just ask about that slide 8, which everyone seems to be referring to, just the surgical admissions, that grey line. I'm just wondering, is the revenue growth materially different from that circa 5.7% in January?
Just going to have a quick look.
I don't think it's wildly different.
No, I don't think it is.
No.
I think it's in line.
Yeah.
Okay, so that would suggest that the mix within that surgical work versus the previous comparative period would not be that different in terms of overnights versus day stay. I guess the question is, are you seeing a lot of growth in day cases versus overnights, and that's blending that revenue growth down? But from your answer, it sounds like it's not.
Yeah, look, I think we're just seeing the same trend, Saul, that growth in day cases does outstrip growth in inpatient cases anyway. We're not seeing it being totally disproportionate at the moment. We're still in Australia, out of our surgical procedures, 65% of them are day procedures anyway. So the day component is significant in what we do regardless. So.
Yep. That's fine. And then just a quick one on France, maybe for Martin. I guess just trying to contextualise the 180 million of government grants. If you look at the sort of the change in revenues for the base business, they declined about 100 or just over 100 million. Is that 180 then just a reflection of that smoothing of that seasonality, or is there going to be some true up, as you mentioned, of that grant that was provided in the half?
Yeah, so there's a seasonality aspect to it. We also recorded some COVID-related payments which covered costs for the March to June period as well. So we didn't accrue those in March to June because the details of those kind of grants weren't compiled when we issued our results. So those are in there as well. So there's a bit of a kind of catch up from the prior period and that seasonality where you'd normally see August and September, for example, being very low months, but it's flatlined with the government guarantee scheme.
Got it. And just on that update to what the agreement might look like, do you know when you might find out as to what's going to happen in the current half?
Well, what we've heard is that the plan for the French government is to issue the decree, in inverted commas, at the end of February. But, we'll wait and see. It does seem to change on a daily basis in terms of what we're hearing from the government. So they're obviously still formulating it at the moment.
Okay, thank you. That's all the questions I had.
Thanks.
Thank you. Our next question is from Sean Larini from Morgan Stanley. Your line is now open, Sean.
Thank you. And good morning, Craig, and good morning, Martin. Hope you're both well, and fantastic operational job in the current circumstances. Maybe, Craig, to start, just to help us further characterise the catch-up opportunity. We noticed on the back of the Medibank and NIB results, they'd sort of changed their provisioning. They're now expecting down from 100% of surgeries to be caught up down to 85%, and NIB have gone from 80 to 60. Still very high numbers, but I'm wondering if you could have any or provide any commentary around that kind of thinking. It would be the first one.
I think it's really hard to quantify, and we always thought it was in that area of sort of 85%-ish that would have to come back into the system. I've got no data to suggest it's any different from that, Sean.
Great, thanks. And maybe, of course, the pandemic's still popping and bubbling away in the background here, but in theory, Australia is the most, sort of post-pandemic-like market, if I could describe it that way. But having those kinds of observations, is there anything you could share with respect to permanent adoption of certain practices that have been implemented as a result of COVID?
In terms of changes in practice?
Correct. So it may be less rehab. Obvious one is increased PPE. Those kinds of things.
Yeah. Look, certainly telehealth. I think we'll see a permanent increase in the use of telehealth, certainly in primary care and in other consultations, mental health, but it will settle back from the peak it was during COVID. There's lots of clinicians who relied on the telehealth ability through COVID who aren't convinced that's the way they want to practice fully into the future, but it will certainly be at a level above where it was. The impact on us in that circumstance isn't that great. It's really about the referral pass. It certainly helps us enhance the way we provide services, but it doesn't change necessarily the referral pass. Rehab, and I think we've called out a few times, particularly day rehab and day mental health, they were impacted by social distancing restrictions as much as anything else. And I think when we get to see what policy changes will happen with government, support for home-based services will increase. But what we've seen, in rehab, and rehab's always a topical one, rehab volumes did drop and have been slow to recover. And the the shift, because I'm about to say rehab, it's not just all rehab. There's different categories within rehab, and so we've seen a significant shift over a 5-year period to neuro rehab, for example. And so when people need rehab, they need inpatient rehab. They tend to be at the more acute end of the spectrum, and so the home-based services, and we're supportive of the home-based services, and we will be providing those as we are now, and we'll increase the provision that we have through our Ramsay home care service. But a lot of it is new work rather than hospital substitution. So I still believe as we shift to more acute rehab that rehab volumes will continually increase. And to be honest, when you do the analysis on what long-term volume growth looks like in different specialties, rehab, regardless of how it's provided, is right at the top of the list, really related to the ageing of the population.
Great. Perfect. Thank you, Craig. That's all I have.
You're welcome.
Thank you. The next question comes from Steve Wing from Jarden, Australia. Your line is now open, Steve.
Thank you. Morning, Craig, Martin and Kelly. Just wanted to ask about the doctor's appetite to recommence their caseload. That's obviously been one of the bigger handbrakes as we come out of COVID in Australia, and are you seeing that change, and is there more change that's required to actually kind of lift those volumes back to where you perhaps expect them to be, given how much has been deferred?
The only change we've really seen, Steve, is in Victoria for obvious reasons. And I think one of the things that we have seen in terms of doctor behaviour is from Victoria a greater acceptance of when these lockdown situations happen, that you do defer the work, whereas we saw a lot of sort of push back 12 months ago where doctors wanted to keep pushing work in. But overall, no behaviour, no less appetite to continue to do more work. Remember that there is a generous supply of doctors, so some specialties are pretty competitive, so they're looking for whatever work they can get.
Great. And just to take the doctor angle one step further, I mean, a number of your larger peers have been, clearly struggling during this period and haven't had as access to the capital markets like yourselves. Does that stand you in good stead to win over doctors to your facilities from continued investment in equipment and the like?
Short answer would be yes. But to make ourselves attractive for doctors, what we've been doing strategically for a number of years in terms of, the more complex campuses, putting in, clinical infrastructure that makes doctors, working lives easier, patient outcomes better. That all comes together, and capital is certainly part of that. That we continue to invest in clinical technology more than anybody else in the industry. That is one component that makes us attractive for doctors.
Yep, great. Can I just turn to you now through COVID, clearly working a lot closer with state government and the opportunities there to do further public work to help them with their waiting lists. How do those type of arrangements look, and how do you then assess, private work versus doing public work? Because clearly, I'd expect one would be more profitable than the other. I mean, how do you weigh that up in the context of your capacity?
Yeah, that's not the profitability piece is not necessarily the case. It's a bit different at the moment in one state, particularly, but that will sort itself out in due course. But for me, it's not a trade-off between doing private or public. It's making sure that we can do both effectively, and certainly still maintain the perception of value with private healthcare. And then the quantum of it, and I've said this before, and I think it still rings true, is depends on how much the states want to allocate to their health budgets to do the catch-up. So there's a political sort of motive behind what waiting list tolerance they have, and then how much they allocate to do the catch up. And we're seeing some, like I said earlier on this call, a couple of states have been ahead of others in terms of engaging with us to do public work, and the quantum of that will depend on how much money they get in the next budget too. And there's a mix of short term, let's do something for the next 3 months, and other discussions which are really about the next 3 years.
Right. Last one for me. Just wanted to get an understanding around pricing in Australia, given you've now completed most of the major renegotiations. We obviously go into the second half with full indexation across procedures, but can you kind of characterise how much first half might have been missing in terms of indexation, obviously acknowledging that you were coming out of government arrangements as well?
I'm not going to specifically answer that one. But all I'll say is that, as has been the trend in the last handful of years, the indexation we've got is the price indexation is less than our cost inflation, and so we've got to do things to manage better to maintain or increase margin.
I wasn't actually after the price. I was after is it like 3 months of first half was across 30% of your business, say, was Medibank related and therefore without indexation? Is that kind of the way we need to think about the price environment for first half to sort of adjust for that going into second half?
Yeah, Steve, it's not material if you're looking for any kind of impact in these numbers. So.
Okay, thank you.
Welcome.
Next caller.
Any more questions?
The operator?
Yes, we do have another question from the line of David Stanton from Jefferies.
Thanks very much. Thanks very much. Might be lucky last here. A couple of questions from me. Firstly, just a more longer-term question. Given the changes and given COVID, can you give us an update on, the Australian private and public issues that you've been facing as an industry, and where you see that going over the medium term?
So, okay, privates in public. When you saw the APRA data released a couple of days ago, which saw a significant decline in privates in public, but I think that's not indicative of what the future will look like, because publics weren't doing any surgical work really, elective surgical work. I think we'll continue to see a downward trend on that. I think what Greg Hunt has done as Health Minister and the discussions with the states have, without using a big stick, has sort of pushed the prevalence of privates in public down. Although I do think it had probably reached a natural high anyway. There's only so much private work that the states can do politically with it without servicing public patients. So I think the longer term trend is, David, we'll see less privates in public. But I couldn't tell you the rate of decline, to be honest.
Sure. And then second question for you, Craig. On the Ascension JV, can you give us an update on, obviously it's paused. When might that sort of kick back in, please?
Well, I'll actually hand that one to Mark.
Yeah. So, David, look, I mean, as Ascension are dealing with COVID in the US and our business is dealing with it in France and UK, you're right, it is paused. Nevertheless, we still think that there's good opportunities in procurement more broadly across our group, and we continue to search for them, whether they're through Ascension or not. Doesn't stop us looking for those opportunities. So hard to say when we'll sort of get back on track with that.
Okay. And then more questions for you, Martin, if I may. Apologies if you've laid this out, but you've given us potential CapEx for FY21 in Australia and the UK. Could you give us a number potentially for Europe in terms of CapEx for 21?
What was it? It is in there. Just trying to find that. It's not on the top of my head. For 21, it is where? No. To Europe. I'll come back to you on that one.
No problem.
It is in our materials somewhere. I just can't find it right now.
No worries. I'll have a better look. And then
209 for the period.
Yep.
Was called out.
Okay, we'll come back to it.
Yeah.
No problem. No problem.
Yeah, thank you. It's 170 to 220 million euros.
Okay, very good. Thank you. And then minorities, again, a bit higher than what I was thinking at least. Can you give us some colour around any updates to the calculation and what potentially an overall number for 21 for minorities, all things being equal?
Well, it depends on what profit we get from Santé is. So, and we're not giving any guidance on that. So, clearly Santé grew and Australia didn't. So, hence the increase in minority interest in the first half. That's in line with the divisional results. And I can't give you a forecast for the second half because I can't give you a forecast for the results of Santé. So.
Understood. Thank you.
Thanks. There's two more callers, I think. Operator?
Yes, sir. We have your next question from John DeConville of C Group. Please ask your question.
Thank you. Martin, I'm just back on that slide 7, maybe a little slower than some of the others. I'm just trying to reconcile some of the numbers here. So I just want to make sure I'm 100% clear. 402 million of EBITDA in the first half. If I take off the 15.6 million, because that's a one-off of the sale, roughly 386. I add back the 48, which is 6/8 for the extra COVID costs of 49 on 335, say, and then you say there's 70 million impact from Victoria. I just want to understand: is that an EBITDA and a revenue impact, so that I should be at kind of 504 or 505 before that at the EBITDA line and add 70 to the revenue line? Can you just confirm that?
Not necessarily. I mean, it's a 70 is an EBIT number. A large part of that is the fact that we've got less revenue, but it's an EBIT number that we've given you.
70 is an EBIT number. Okay. And so when I do all of those calculations, I come up with about an 18.5% margin versus an 18.9% margin that PCP. I know you said to David you can't think about it like that, but we will at some point. So all things being equal, we just need to think about it in the context of that 70 million not being there in the second half, right? That will go back to normal, and then
if there's no more lockdowns and restrictions on surgery, obviously, yeah. And as we've said, the margin is slightly lower because of the mix that we've had. So, with non-surgical down and surgical up, that is going to have a negative impact on margin.
And already the snap lockdowns will have had an effect. So.
Yeah, in this half, some of those snap lockdowns have had a bit of an impact, yeah.
Understand. No, that's very clear. Thank you. I was just interested in this LTI target you've got there on page 9 of the 3.6 of the account. So I just want to be clear. This ROIC outcome, that's for the group. Is that group wide, or do you separate out Australia and the UK and France? How does that work?
It'll be a group number, yeah.
Right, because the historical cost base of Australia is obviously, that's a very low cost base, and the ROIC of the group, the ROIC of Australia is materially different to that of France, which is well, depending on what the cost of capital is, but it's probably less than the cost of capital in France. So you're just doing it at group level.
At a group level, and it's a gateway. So the EPS component of the LTI won't pay out unless ROIC is above WACC for the period.
Okay, understand. Thank you. And just finally, Craig, if you don't mind, I read with interest the transcript of the NIB call from the other day. Your industry colleague saying about the government reviewing medical devices again, quite egregious the prices Australian consumers are paying, etc. I just want to confirm, obviously they're going quite hard at this and they believe that the prices are very high, but I want to confirm, I know we went through this like 5 years ago when Chris was still there, but if the prices of the medical devices materially decline, you don't expect any impact on your business?
Yeah, immaterial. So most of the prosthesis is a pass-through. We'll have some volume discount that I think Chris called out in that Senate inquiry, but it's not material.
Yeah, that's great. Thanks for taking the questions.
You're welcome.
Once again, if you would like to ask a question, you may press star 1 from your telephone. It's star 1 to ask a question to our presenters. The next question is from David Bailey from Macquarie. Your line is now open, David.
Yeah, morning, Craig and Martin. Just one from me. Again, we'll go to slide 8 if we can. The grey line showing improved trajectory, December, January type thing. Within January and December, just wondering if you observed anything from a specialist perspective or surgeon perspective such that they were working more so in January and December this year than they would have in the PCP. So what I'm trying to understand is whether you think you can sustain that kind of growth as you start to cycle, more seasonally stronger months in February, March, etc.
Yeah, there's only a small element of that, David. We anticipated that would be a lot more, but they generally took their holidays. So it's not that different from the previous period.
Okay, so you think you can it'll be volatile, but just retain an elevated level of growth against stronger prior periods over the next few months or so.
Sure. It won't continue on that trajectory, but
it might. All right, that's all from me. Thanks.
It might. Like just to clarify that, I can't see 7% going to 15% growth. So.
No, I just meant to sustain that kind of level. That's fine. Okay, that's all for me. Thanks, Craig.
Okay.
Right, and once again, if you would like to ask a question, you may press star 1 from your telephone. It's star 1 to ask a question. The next one, the question is from David Lowe from JP Morgan. Your line is now open, David.
Hello.
Sorry, David Lowe again. John raised this issue of prostheses, and certainly the rebates is part of it, but there's also this talk of quite significant reform with the general miscellaneous category and with the price list generally. And some of the other hospital groups have talked about fear that that's going to have to be absorbed by the hospitals. Just wondering what your expectations are with the next round of reform.
Yeah, there's a lot of discussion going on. As you could appreciate, there's submissions went in 2 weeks ago from different parts of the industry. The intent with the general miss, and so for those people who don't understand, general miscellaneous is a catch-all for lots of things, being glues and staples and other things that you need to implant prosthesis. The intent was to not. I'd say the intent. That's probably wrong. What the health funds are pushing for is that they come off the prosthesis list, and the government view is they don't know whether that's the right way to treat them or not, but certainly not for the cost of them to be absorbed. There'd have to be other funding mechanisms put in place to cover those.
Okay, look, one last one from me. The comment was made that the volume rebates accounted for about a quarter of that 8.2 million a month. My sense from what was said was that's all moving in the right direction, and as long as Aussie volumes pick back up, we could knock that 2 million odd a month off fairly soon. Is that the right way to think about it?
That would be the right way to think about it, yeah.
So it's all about Australian volumes. It doesn't matter if France and the UK remain locked down and not much happens.
Well, I think if France in particular, like if there's no surgery, then that will have an impact clearly. But based on what we're seeing currently, then it's early days in the current calendar year, but all other things being equal, it should be okay.
Yeah, Australia has a disproportionate impact on that.
Yeah, that's right.
And sorry, just the right way to think about it, it's probably not a month-by-month thing then. I mean, it's really sort of where you end up in the calendar year as to whether it it comes through.
Yeah, correct. Yeah, we won't know until the end of the year.
Yeah. All right. Sorry to drag it out. Thanks very much.
It's okay. No problem. Thanks.
Thank you. Once again, to ask a question, please press star 1 now on your telephone. The next question is from John Deckenbell from C Group. Your line is now open, John.
There, John.
Hello, John.
Yep, here I am. Sorry about that. Some of the line items I was hoping you could just give us a hand on, no guidance overall, of course, but interest, D&A, and CapEx. I mean, is the second half going to be materially different to the first half? And we can obviously come up with our own views on revenues and EBITDA margins, but any help you could give us, Martin, would be appreciated.
I think it'll be rash for us to give you guidance on those kind of lines, John. I mean, particularly interest, it's going to really depend on what the business looks like and where that leaves our net debt over the course of the period. So I'd be loath to try and give you guidance on those numbers. I think the only thing we have helped you with is an effective tax rate. So
should be about the same. Surely the CapEx guidance is not going out on a limb by telling us what you think you'll spend in the second half.
Yeah, no, we've got CapEx guidance in all of our sections there. So we've given CapEx guidance, but trading results will impact on interest. So.
And depreciation and amortization again shouldn't be any materially different to the first half, right?
Well, not particularly, but we're not giving guidance on that. But no, it shouldn't be massively different.
Okay. I mean, they're not operating items. I mean, it's just kind of. It just keeps the consensus at a sensible level if you can help us with some of those things that are clearly not market sensitive.
Yeah. Appreciate that.
Once again, to ask a question, please press star 1 on your telephone. It's star 1 to ask a question. There are no further questions at this time. Presenters, you may continue.
Okay. Thanks very much, everyone. We'll call an end to it there then.
Thank you.
Thanks for joining.